You guys are the main event, and you're standing between this group and cocktails. So I thought maybe what we could do is just have each panelist introduce themselves and just give a snippet on who you are and what you do from an M&A perspective.
Got it. My name is Jorge Espinel. I'm the Executive Vice President of Strategy and Corporate Development at NewsCorp Digital Media Group. And my team leads the direction of the strategic assets around in the digital area across the company.
Hi, Jim Fowler, founder and former CEO of Jigsaw. We were acquired by Salesforce back in May.
Suriyapa, I head up corporate development at SuccessFactors. I've been there for 2 years and basically was brought in to build that group up from scratch.
Charles Carmel, I'm the Vice President of Corporate Business Development at Cisco, responsible on a worldwide basis for all of our external growth strategy and all of the transactions from venture capital to high-level partnerships and acquisitions to go and support that strategy.
I'm Shannon Soqui with Advanced Equities. I run our West Coast investment banking office, and I'm in charge of M&A with all of our portfolio companies, helping them pursue their strategic alternatives, whether it's going to IPO or doing additional financing or pursuing M&A.
I'm Lehot. I'm a corporate securities and M&A partner at Sheppard Mullin, based here in Silicon Valley. You met my partner Stephanie Brecker, who leads our clean tech panel, our clean tech group earlier today. And I represent public companies like AOL, Seagate, and others in their acquisition strategies. I represent financial buyers like Silver Lake and late-stage private companies on the sell side.
Terrific. And so we want to make this panel interactive, so I'll start with some leading questions. Across the panel, we have a pretty diverse group. But then, definitely want to open up the questions that the audience has for the team up here. So maybe we'll start with just the corporate buyers, Jorge, Charles, and Seksom. And maybe start with Charles first. So the current environment, how has Cisco's mindset changed or stayed the same at your company, given has it been easier or harder to get transactions done, given some of the volatility, given some of the multiple trends that we've been talking about, and how are you guys thinking about that?
Well, Cisco has had a very long history as an acquirer. We've done over 145 acquisitions going back to 1993 in the early days of the company. We've been very consistent in that strategy. We've done deals every year during that time frame. And we look at one of our strengths as a buyer as being that we play through the economic cycles and really try to be consistent in how we approach acquisitions. Try not to play too much into the hype when things are up, and try not to get too scared when things are down. So our last couple of years have been pretty consistent with what we've seen. In times prior, we generally do about 5 to 10 acquisitions a year. Over time, those have tended to get a bit bigger in size, but we still view the sweet spot for us as being smaller startup-oriented acquisitions, and then, when appropriate, the occasional sort of mid-sized public company to help accelerate different activities that we have around the business. So I haven't seen that change significantly, and I don't expect it to change meaningfully going forward. And again, we view that as one of our strengths, which is the repeatability of that process and the way it's been embedded into really how we think about the holistic approach to innovation and building new market opportunities across the company.
And Seksom, you guys haven't been as acquisitive historically. You were brought on and you kind of started the whole effort around M&A. You've done a couple smaller transactions. So how are you guys thinking about M&A in the current environment, and particularly if you could speak to just how your board thinks about M&A, given you haven't historically acquired in this type of environment?
Yeah, it's a loaded question. I mean, if they didn't like acquisitions, I think I'd probably should get my resume out. But in all seriousness, I think that we look at our market as a huge greenfield opportunity, and our biggest problem as a company really is that we can't actually hire fast enough, and we can't get in the market we want to get to fast enough, and it's a function of how SaaS economics work. So SaaS 101 is, if you want to show a profitable income statement, you only get to spend as much as like what your revenue is. But in the SaaS model, it's bookings and bookings margin that really kind of drives what the actual cash flow and the success of the company is. And so we've got a natural speed bump that we can't overcome, and that means that, as a practical matter, we can't spend from an income statement perspective everything that we'd like to spend on growing. And so the acquisition strategy very much allows us to look at areas that we're not able to fund because of the limits we have, and hopefully be able to accelerate into those spaces. And so I think we look at those two as very complementary. And to your point, I think we haven't done very many in part because we've got to be very focused on having good filters to ensure that we don't get ahead of ourselves as we're as we kind of concentrate on being able to have a repeatable process the way Cisco does.
And how about Jorge for NewsCorp? What are you guys looking at? Particularly, I guess, this audience is probably interested in the digital side, how you're thinking about digital transactions, given some of your recent activity.
Yeah. So I would say in the digital area, we've been in a period of fixing and really shaping up the portfolio of assets. There were some assets that didn't belong inside the corporate infrastructure, so we did some partnerships and with some venture funds. We took out Photo Bucket and partnered with Steamboat Ventures and a company called Ontela. They own a portion of the company, we own a portion. And so we've explored that scenario as we look to make sure that the digital assets have the right infrastructure to be able to compete in the marketplace. And so some of the comments that you may have heard related around my space evolves around that is whether some of the digital operations that we have had in place for some time are better, are in a better position to compete when you have external financing and you have the ability to more adequately compensate talented teams. So I think that is the process that we've been in. Having said that, the company continues to look at natural spaces in the digital area that would strengthen their core businesses. We've done some small acquisitions. We did a Yardbark acquisition related to our Fox Sports business. And I think as certain spaces get a little bit more defined, I think we'll go back in and participate a little bit more actively than we have up to this point. So a lot of the focus, I think, around M&A and the company has been around our core businesses from a television perspective or some new areas that may not be as competitive like education.
So maybe now we'll talk to Jim a little bit, who's our representative entrepreneur and recently sold his company and can offer some perspective. I think probably what this group would be interested in hearing about is just how you and your board and group of investors thought about the IPO standalone path versus sale of the company. Why now was the right time? Why was the right partner?
Well, as with probably most deals, it wasn't a real simple decision for us to get to. My board would probably be the first to say that they weren't super excited about selling the company at the time. We were growing quickly, we were cash flow positive, and they would have been happy for a bigger outcome. And for those of you who heard Sandy Miller talk, I think he was spot on about his concept that your wife plays no small part in a decision like this for an entrepreneur, especially one where you're a first-time CEO like I was. But really what we kind of boil down to is really making a case for why it made sense at the time. I mean, it's always risk. To me, I was much more concerned about my team than I was about my board. I think anytime you have a potential to deliver a high multiple outcome to your investors, and the founder CEO and his team wants to do the deal, I've heard from many VCs it's difficult to say no to that because there's a lot of downside to bust that, especially if it's a good deal. So I was far more concerned about managing it with my team than I was with the board. That said, the fact that my board wasn't super motivated gave us a lot of ability to help formulate some key parts of the deal that were advantageous to Jigsaw.
As they say, companies most often get bought, not sold, and so that's the best position when you have kind of lots of runway on your standalone path. Maybe Shannon, you can talk about this from you guys advise a lot of private investment and how you advise companies when they're thinking about taking on a new investor, and particularly a strategic investor versus a financial investor, in this environment, what are some of the things that you're seeing?
Well, we always strive for, like one of the guys said yesterday, the number one factor in a successful company is the management team. So when we look about the composition of a board, we want to make sure the board is in the right position to help and nurture that management team. And often we like having strategic investors come participate. They may be an observer. They may not often are they actual board members just because of liability reasons or what have you. But it's not so much the designation of they're an observer or a member. It's how much can they contribute? Can they be constructive in opening doors and helping grow and coach the management team? Because usually if it's a first-time CEO, he hasn't scaled a company before. He hasn't had to overcome a lot of the challenges of growth. He's good at making a product or marketing or building a small team, but it's crossing that chasm and getting to be a $100 million run rate or a $1 billion run rate that the corporate strategic guys actually can be very valuable on providing insight and help. And so we're generally open. It's really up to the existing investors. Do they want another guy on the board who's chiming in or who may have an ulterior motive? And so, yeah, board seats are very, very precious, and they're not given away lightly. But I think people can still be active by being, and if they're an investor, and help out, and we encourage that a lot.
Terrific. So, Louis, kind of moving more into the legal bills, in terms of what do you see, on private company boards when they're trying to get a transaction done? What do you see as some of the biggest kind of legal impediments that are often debated? I mean, there's a couple, VC, hot buttons. What in this environment, what are you seeing as kind of the most critical of those?
Well, I think, for the last couple of years, we've seen a real disconnect between expectations of return and where a company is going. So it's really building a consensus about where things are going and who has the right to force their point of view. So I think certainly we've seen that on the private company side.
And that's maybe a good transition to talk maybe just a little bit about valuation. And Charles, you've probably of the panel seen it all, across the board in different markets. And I think in environments like this where there's probably more sellers than buyers, particularly with the private company set. How do you think about valuation and bridging valuation gaps? Clearly part of the equation is what the must-have asset versus a nice-to-have. But how does Cisco think about prioritizing when you're probably getting approached by so many companies that fit in so many of your different spaces? The M&A opportunity in any given environment, and then bridging valuation gaps that are clearly probably one of the key things you spend a lot of your time doing.
Yeah, I mean, there's no doubt valuation is one of the critical inputs to get the deal completed. It's not the only one. So we're always balancing the relative valuation of a company versus the strategic benefit inside of Cisco and the opportunities that we see in that combination. But we try very hard as a repeat acquirer to understand not just the implications of valuation of returns of one deal, but the implications of valuation as a statement for the next deal and the deal after that and the deal after that. We have always viewed our reputation as a repeat acquirer as being more important than any individual deal negotiation. And so when we make a decision to stretch a little bit on valuation, we're not just having a debate about what does it mean on this deal, but what does it mean on the next one. What that's played out over the last couple of years, we have been very thoughtful as we saw both the market hit a low point and the opportunities that presented for us. And you saw us move on a couple of larger acquisitions a little bit over a year ago with both Hamburg and Starn being $3 billion plus public company deals that we felt like not only made strategic sense, but there was an opportunity in terms of where the markets were to be aggressive at a time when others maybe had a little bit more constraint. And now we're sort of in certain segments of the market on the other side of that, which is I think there are a number of situations in the last 6 months or so where we've seen strategic alignment, but we've struggled in valuation. And as a result, we've had to hold ourselves back. I think this is one of the more dangerous times when you see quick run-ups in the stock market, a little bit of volatility in the economic situation, and a lot of people viewing there to be a scarcity of value in particular subsegments. It's a very dangerous time for a buyer. And so certainly in the right strategic situation, we're always willing to jump in and get things done, but we're also going to be cautious when we feel like we're in some of these times when bad decisions can get made and we look back, in retrospect on paying up in certain markets at certain times.
And Jorge, what do you think of that? I know you guys have been more, as you said, when you're looking internally to clean up, but a lot of the spaces that you guys play, particularly from a digital, whether it's social or mobile, or some of the other spaces, how are you thinking about valuations in those spaces and when the right time is, to start looking externally? What are your priorities? How do you think about that?
Yeah, I think increasingly you really need to look at your ability to actually help a company propel into growth and really unlock the value that they don't have. If you go for the premier companies in a particular space where you don't have an ability to really extract value, I think the premiums are too high right now to really go after those companies. And as I think as Cheryl said, is given the economic uncertainty, it is difficult, especially in the digital space, to differentiate between what is driven by the fact that there are, winner takes all dynamics versus an appetite for just getting to a particular space. So I think we'll probably be more cautious. We've been in this space now for a while, and that's part of the reason what we came into to look at opportunities and be more strategic about how you build the relationships with the right companies. You meet them early, you cultivate a relationship, and you identify the opportunity earlier before someone else gets in there. I think that's probably what we'll pursue, but we're not necessarily overpay.
So proprietary deal flow.
You'll try to build, yeah.
The buyer's dream. Right?
The banker's nightmare.
No, not all the time. And Seksom, so you guys haven't been as acquisitive, but you do have two recent M&A deals under your belt. What are some lessons learned, as a fairly new acquirer in terms of buying private companies, how the integration has gone, or how maybe you would have done things differently navigating that?
Yeah, look, I think in short, I think the one thing I know now for sure is that no matter how, when you walk into a company, actually a lot of the team members have done acquisitions. I think everybody on our team listed how many acquisitions they had done, and that list was better than 50 or something like that. But that wasn't at all relevant to what happened, which is that when you put a new team together with new dynamics, especially a small, agile, fast-growing company like ours, the lack of institutional history and process around it actually creates the greatest challenge of getting a deal done. And so I think that most of the stuff we've learned is really around process, actually. And, we certainly strive to have, best-in-class process. I think the way Cisco does. In fact, one of our key team members came over from Cisco, to lead our integration side, to your question. And, when we thought about, what do we need to do to be able to acquire effectively and repeatably, the first thought was, someone who has the Cisco, pedigree of having, led 12 or so integrations and do that is an important component of being comfortable that you can step up into your first one. The reality, though, I think, is that we will continue to make mistakes. Just hopefully they won't be the same ones that we made the first time around.
So Jim, what advice would you give other companies in the audience kind of going through an M&A process for the first time, with a large strategic acquirer? What are some lessons learned there, and maybe some pitfalls to avoid, whether or not you experience them?
So right after the deal went down, I spoke at the Bessemer Cloud Conference, and Josh James did the dinner speaking, and any of you seen him speak, he's quite an entertaining character. And he was talking about all of his M&A. And at the time, of course, the deal was 2 days old. And but one of the things that cracked me up was he was talking about one of the hardest things for him is how to deal with all the wacky founders that you get after you do an acquisition. I thought, I'm not going to be one of those wacky guys, right? And but what I really took out of it is he went through a bunch of funny stories about how he couldn't really figure out what motivated a founder, and it was frustrating because what would normally we take as common sense, like, let's put a big money number in front of the founder, this or that. It doesn't always work. So I really think that the founders play a key role. You've heard from, in the audience that you guys bet on CEOs and teams, I'd really say, really get to the bottom of what motivates that founder and make sure it's a good fit. In our particular case, it actually worked beautifully because I was clear from the beginning that I'm not a guy that would be good at running a large division within a big company. But I had a COO who they loved, and it was clear from literally day one. I handed over the keys because I didn't want anyone on my team to be confused about who was running Jigsaw at that point in time. So I think Salesforce really did a great job with that, and I think if they wouldn't have done that, everyone on the team would have been looking at me and looking at my COO and trying to figure out what's going on. And I just think understanding that motivation is key because I think it's as important after the fact as it is going into the transaction, at least until you've got a point of time where the founder or the CEO is going to leave.
Switching gears a little bit, Louis, right now in a lot of M&A negotiations, deal certainty has been a very hot topic. It's been getting a lot of press, on the front page of the Wall Street Journal, recently across tech specifically, but across other transactions as well. How do you advise boards and companies around deal certainty, and what are some things to look out for?
That's a really good question. People really were stung in 2000 and late 2007 through 2009 with a lot of high-profile transactions where buyers walked away from deals. And so you saw in deals getting done in 2009 that really the risk of things falling apart between signing and closing were really shifted from the seller to the buyer, and that really has continued. So I think certainty from the buyer perspective or from the seller perspective has really improved.
What about from a regulatory perspective? That's been getting a lot of press, just given a lot of the bigger companies have been moving into new spaces. Regulatory review processes have been taking longer. What are some of the mechanisms that people should think about in terms of deal certainty as it relates to regulatory?
Certainly. So in the last year and a half, obviously in the United States, we've seen a lot of new regulations come into play, as well as increased enforcement of the existing regulations. And so what am I talking about? I'm talking about the antitrust rules being enforced at the Federal Trade Commission and the Department of Justice. In a recent gun jumping enforcement action, where the Department of Justice jumped in and said two companies were cooperating before their merger had been completed. So it's really controlling the integration process as you go down. With the SEC, there's been a lot of new regulation about what shareholders can do and what they can put on the proxy. And so advising boards really is being really prepared and well advised from the outset.
Sure. Shannon, when private companies are thinking through, who to allow to invest in their company right now, there's so much capital. I covered in my initial comments, just, all the cash availability. There's lots of capital chasing probably, scarcer number of, high quality opportunities. So how do you advise private companies when they're thinking about, who makes a good investor, in these private rounds?
Yeah, that's actually another good question. I think there was a panel this morning where Todd Chaffee said there's dumb money, smart money, and smart money you like to work with. At the end of the day, do you always take the highest value? No, you don't. Sometimes you'll take a lower value in raising money to get the right partner, and it depends what your goals are. If the management team is set on their execution, they know exactly what they do, and they just need more capital, and they don't need more help around the board, then that's not a consideration. But if it's earlier stage where they need a door opened at in a particular market or a particular industry or a geographic region, then yeah, maybe you take a little bit less in value to get the right partner. We look a lot at the terms people offer up in their term sheets to decide whether or not this is going to be a workable party, and do the terms fit the preferences that are already in place and so forth. So a lot goes into it. You would think maybe intuitively you take the highest price, but that's not always the case. And a lot of times we get competitive offers, and it goes to certainty of execution. Yeah, I could go down this path, but this guy will take 2.5 months of diligence, get to his final
meeting, his 8th meeting, and pull the rug. So, speed of execution, certainty, value, those are kind of the 3 things we look at, and you may get 2 of them. It's like hiring a construction guy. He'll bid it. You want it to come under bid, on time, and the way you want it. Pick 2 of the 3. That's what you're going to get. You hope to get all 3 when choosing investors, and those are things we look at.
So maybe transitioning on the point of capital, as a buyer, Charles, how do you think of just return on investment? When you're thinking about buy versus build versus you guys also have taken investment in companies. And right now a lot of guys like Cisco and kind of the top 20 tech companies have so much cash on their balance sheet. So how do you think about the deployment of capital in the context of M&A? And is that a focus for you guys, or how do you think about that more broadly?
Yeah, I mean, we are in a fortunate position. We've got $40 billion in or more in cash. Not all of that is available, or at least not easily available onshore in the U.S. given the current tax policies, which we hope will change. But given the current environment, we still, even with the tax regulations, do have pretty good access to cash either on the balance sheet or in the capital markets. For almost all situations that we're involved in, availability of capital is not a constraining factor for us to look at any particular acquisition or investment. We're quite active as a corporate venture investor. So it does come down to really project-based return assessments. We are very thoughtful in both the analysis up front on either a venture investment or an acquisition about the return profile that we think we're going to get and its ability to exceed our cost of capital that our shareholders expect as owners of the company. And then we hold ourselves accountable to that. So on the investment side and on the acquisition side, we have a complete finance team that supports my group. We meet on a quarterly basis. We have a full review every single deal, get to look in terms of how to perform relative to what we said it was going to do. And we tweak our assumptions on the next deal based on what we've learned on each one of the past deals to say, when we make our next case and we put forward an assessment of return, are we in fact going to be able to make that case? And we're always trying to refine that process. I've always said that as a repeat acquirer, repeat investor, it's not about, you're not going to stop making mistakes, but your hope is that you're going to make new mistakes and learn from the ones that you made in the past. And as a result, you're going to always be doing a better job of hitting those goals and exceeding those return metrics.
And do you, just a follow-up question there, do you think about using stock? I mean, we see, Google and the AdMob deal, stock as consideration, or Amazon Zappos. How do you think about that?
So we have used stock over the years, including in some relatively recent situations. We used stock, for example, in the Pure Digital acquisition, which was a very exciting deal for us around the camcorder and all the things we're doing in the consumer space. That was a situation like many others where we generally have a preference for cash, but we also have a very active stock buyback program. And so if there's a buyer that has no confidence in Cisco stock or has a particular reason in terms of structuring where they feel like getting stock has added value to them over getting cash, we have the flexibility to use that stock, and then in most cases, assuming we don't enter new territory in terms of size of the deal, we buy that back on a relatively quick basis in the market. So for most situations, we'll start with a preference for cash, but with an open mind if stock is the right answer from the seller's perspective, to look at that and be open-minded about it.
I think from a speed of execution point, obviously cash when you're a seller, it's going to make your deal go a lot faster. It's money in the bank. It's real. Stock, on the other hand, when there's this big valuation gap, can be really helpful in bridging the gap because you're telling your investors, hey, this isn't a terminal value. This is, in the end of the day, you're getting this stock, which you can appreciate, and you're still in the game.
Perfect. So we have a few minutes left. If maybe there's a question from the audience, we'll open it up for questions.
Everyone wants a drink.
Yeah. So thank you for coming. Hopefully you found the panel interesting and compelling. And